Welcome to a continuation of the chapter on materials. Remember, materials is unit 4 or chapter 4. We have already looked at part 1 on materials, and in part 1 we looked at introduction, that is types of materials. We also looked at classification of materials. We looked at material records, and we looked at the first part of stock valuation. In the first part of stock valuation, we saw how to value stock using the method first in, first out. And this is the example that we used under first in, first out. In this session, part 2 of the chapter materials, we are now going to look at last in, first out. So in this method 1, it was first in, first out. We are now going to focus on last in, first out. Let's once more read through the equation to enable us go to the example. ABC Limited has the following transactions. 1st January, opening inventory was 600 units valued at 300 per unit. 5th January, purchased 1,800 units at 400, and on 8th January, purchased 2,200 units at 500. The next date was 15th January. We sold 4,200 units. On the 20th of January, we purchased 3,200 units at a price of 600. And then on 28th January, we purchased 2,100 units at a price of 650. And on 30th January, we sold 5,400 units. So we want to determine the units and value of closing stock on 30th January using the second method, which is last in, first out. So this is the method we are going to use. Last in, first out. Last in, first out. So let's post the details from the beginning. On 1st January, we have seen there is the opening stock. Our opening stock, as we looked at in the previous example, our opening stock is a balance. Our opening stock is 600 units at a price of 300. So 600 times 300 is 18. 1, 2, 3, 4. So it's 180,000. So that is our first date. The next date is 5th January. We purchased 1,800 units at a price of 5th January. There was a purchase. We purchased how many units? 1,800 at 400. 1,800 at a price of 400. So if we use our calculators, everyone should be using their calculators, times 400, 1,800 times 400, it gives you 720,000. So we get the balance from that purchase. So purchases increase the balance. So it is 600 plus 1,800, it gives you 2,400. And then the other side, we have an amount of 180,000 plus an amount of 720,000. 180 plus 720, it gives you 900,000. So we are done with the 5th of January. The next date is 8th of January. We purchased 2,200 at a price of 500. So on the 8th of January, we purchased again, the transaction is a purchase. We purchased 2,200 at a price of 500. 500. So 2,200 times 500. It gives you 1,100,000. 1,100,000. 100,000. So we have 2,400 plus 2,200. That is 4,600. 900,000 plus 1,100,000. That gives you 2 million. 2 million. So that is the end of 8th January. 8th January. Now on 15th January is when we had the first issue. We sold 4,200. So 15th January, there was a sales and the total sales was 4,200. Remember, in the previous method, we were issuing the first followed by that and that. But now in last in, first out, we issue the last is now 2,200 at a price of 500 to give you 1,100,000. And then next, remember we are to issue a total of 4,200. We have issued 2,200. We are finished with that. We next go and issue going up the ladder in the last in, first out. So here, the next we are now going to issue 1,800 at a price of 400 to give us 720. So this gives us a total of 4,000 issued. And in the last one, so we have exhausted that, is 200 at a price, 200 is now from here, at a price of 300. So that gives you 4 zeros. So it gives you 60,000. So that is what happened on that date. Now let's get the balances. 4,600 minus 2,200 is 2,400. 2,400 minus 1,800 is 600. 600 minus 200 is 400. We go for amounts. 2 million minus 1,100,000 is 900,000. 900,000 minus 720,000 is 180,000. 180,000 minus 60,000 is 120,000. So we are done with that date. We go to the next transaction is on 20th January. Now on 20th January, what happened? We purchased. So we purchased. Now when we purchase, it's a receipt. We purchased 3,200 at a price of 600. So we do our multiplications using our calculators. 3,200 times 600. So that gives us 1,920,000. 1,920,000. Our balance is 400 plus 3,200 is 3,600. And we have 120,000 plus 1,920. It gives you 2,040,000. So we are done with 20th January. The next date is 28th January. 28th January. Again, we purchased. We purchased what quantity? 2,100 at a price of 650. So 2,100 times 650, it gives you 1,365,000. So the balance is increasing. So this will give you 5,700 and the amount is 2040 plus 1365. So that gives you 34,050,000. So that is on 28th. And finally, on 30th January, we sold. There is sales. And we sold a total of 5,400. So we start with last in, first out. The last is 2,100. So we have 2,100 at a price of 650 to give us 1,365,000. Okay? And then we have exhausted these. We go to 3,200 at 600 to give us 1,920. 1,920. And the last one, we are still remaining with that is, this is 5,300, and we have to issue a total of, so we have issued these. So there is 400 that is remaining here. So we will take 100 at a price of 300. The issue price of these, the price of these, receipt price of these was 300. So that gives you 300. Okay? So we need to get the balances so that we conclude on these. So 5,700 minus 2,100 is 3,600. 3,600 minus 3,200 is 400. 400 minus 100 is 300. Same to amounts. 3,400,000 minus 1,365. Let's calculate that. 3,405 minus 1,365. It gives us 2,040. Okay. Next we have 2,040 minus 1,920. It gives us 120. And there is something not right. Let's redo it. 2,040, 204,000 we are just trying to verify the figures. 4 million minus 1,340 is 2. Let's redo. There is a small error there. 3,405,000. This amount minus 1,365. It gives you 20. Okay, there was a zero missing there. There was a zero missing there. Okay, 2,040. So 2,040 minus 1,920, 000. It gives you 120,000. Okay, this was okay. Let's redo it. 3,405 minus 1,365. It gives us 2,040,000. Okay, that's now fine. Minus 1,920. It gives us 120,000, and 120,000 minus 30. We are now right. It gives us 90,000. So this is using last in, first out method. The final closing inventory units is 300 and the value is 90,000. That is last in, first out. The last method is known as average cost method. So in our average cost method, we want to now look at it. Using the same question, we see where the difference is. Average cost method. So on 1st January, there was opening inventory. So our opening inventory, as usual, this was 600 at a price of 300 to give you 6 times 3 is 180,000. 180,000. We are done with 1st January. The next date is 5th January. Remember, we are now in average cost method. On 5th January, we purchased 1,800 at a price of 400. So 1,800 times 400, that gives us 720,000. 720,000. Now, what is our balance? 600 plus 1,800. So 600 plus 1,800, it gives us 2,400. 180,000 plus 720,000. It gives us 900,000. 900,000. And then we go to the next date is 8th January. 8th January, again we purchased. So on 8th January, we purchased 2,200 at a price of 500. So 2,200 times 500. That gives us 1,100,000. 1,100,000. Again, this increases the balance. So this will be 4,600. 900 plus 1,100,000 is 2 million. Okay. We are progressing on well. So that is the date of 8th January. The next date is sold. 15th January. Now this method is different. We sold, in this method, we sold 4,200. We don't look at what came in first and what came in last. We calculate. So first of all, we want to sell a total of, we now put the total here, 4,200, and we calculate an average price of 2 million divided by 4,600. The amount just before the issue date divided by the quantity issued. So that is 2 million divided by 4,600. And that gives us 435 if I round it off. 435. So you take 4,200,000, 4,200 times 435 if it's rounded off. This gives us 1,827,000. And then you reduce by that. This minus that is 400. And 2 million minus 2 million. 2 million minus 1,827,000, it gives us 173,000. So this method is fairly straightforward compared to the others. You calculate what we call an issue price. How do you get the issue price on 15th? The amount just before the issue date divided by the quantity. So we go to the next date is 20th January. 20th January. Again now in this date, we purchased. We purchased what quantity? 3,200 at a price of 600. So 3,200 times 600. So that gives us 1,920,000. Okay, 1,920,000. And we have 400 plus this is 3,600. And 1,920,000 plus 173. It gives us 2,093,000. Okay, that is that date of 20th. We go to the next date is 28th January. On 28th January, again, we purchased. We purchased what quantity? 2,100 at a price of 650. So 2,100 times 650, it gives us 1,365,000. 1,365,000. We increase it. This 3,600 plus 2,100 is 5,700. And 1,365,000 plus 20,93,000. So it gives us 3,458,000. So that is the total on 28th. And finally, on 30th January, we sold. There is sales. We sold what quantity? The last date there, we sold 5,400. And we agreed on how to calculate the issue price. The amount just before the issue date divided by the quantity balance. So divided by 5,700. It gives us 607. So this is 607. This divided by that is 607. So we have 5,400 times 607. It gives us 3,277,800. So 3,277,800. And then we reduce this minus that is 300. And finally, 3,458,000 minus 3,277,800. It gives us 180,200. And the quantity, when we use average cost method, is 300 units, and the value is 180,200. And when we go to the previous method using LIFO, the quantity was 300 and the value was 90,000. And in the first method, the quantity was 300 and the value was 195,000. So we have looked at three methods of valuing inventory. Number one, first in, first out. Number two, last in, first out. And number three, what we call average cost method or weighted average cost method. And that brings us to the end of these unit materials. So what have we covered in part 1 and part 2? We have looked at types of materials, classification of materials, material records, and finally, we have looked at inventory valuation. Which method have we looked at? First in, first out, last in, first out, and average cost method. And that brings us to the end of unit 4, which is material cost. In the next unit, we will look at labor cost. That will be in the next session, labor cost. Thank you for your attendance.